Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The global bond sell-off continues as investors bet on a slower pace of rate cuts from the Fed. The dollar gains against all G10 peers. A big day of earnings from some of Europe's largest companies. We're going to bring you the results from Deutsche Bank and Roche and speak with the CEO of Volvo Cars. Plus, McDonald's shares slide after its quarter pounders are linked to a severe E. coli outbreak in the US. At least one person has died, with nearly 50 falling ill. Deutsche Bank earnings are crossing third quarter pre-tax profit. It is a beat for the German lender, 2.26 billion euros, above the estimates of just above 2 billion euros. So it's a comfortable beat on that metric for a stock that is up 35% year to date. Deutsche Bank, by the way, also seeking authorization for further buybacks. There were question marks as to whether or not there would be further buybacks. We also, of course, look for the fixed sales, the fixed income and currency sales. And in the third quarter, plus trading revenue, that came in also as a beat. 2.1 billion euros. The estimates had been for 2.01 billion euros. So it's a beat in terms of fixed income and currencies trading, and on the profit line as well for the third quarter, a beat coming through from Deutsche Bank. Again, the stock is up 35% year to date. We are going to be hearing from the Deutsche Bank CFO in just under half an hour. So stay tuned for that interview. Still on the earnings front, Roche, the drug maker, of course, listed in Switzerland, coming through with a full year outlook that is confirmed. Third quarter sales are a beat for Roche, 15.14 billion Swiss francs. The estimates had been for below 15 billion Swiss francs. So it's a beat on that line. In terms of third quarter sales, also a beat. Again, third quarter sales a beat for Roche. Analysts are scrutinising the pipeline in terms of some of the new drugs. So the details on that will be important as well. And we're going to be speaking to the Roche CEO at 7:30 a.m. UK time on the opening trade. The stock up over 11% year to date on that drug maker. Let's go to the markets right now. The focus and the interest is far less on the equities at this point and far more in terms of the bond markets. Equities are basically doing nothing over the last 24 hours. European futures are currently flat. FTSE 100 futures in similar territory, looking for a new catalyst. The action, though, is in the bond market. S&P futures currently pointing lower by 0.1%. Nasdaq futures off by 24 points. Let's flip the board on that discussion around the bond market and stay on the US 10-year, which is back above 4.2. The last time I checked at 4.22. That's the 2-year, but at the long end as well, you continue to see that sell-off in terms of the Treasury market. Yields are up again across the curve around 2 basis points. So that continues. Strong dollar also a story. 108 on euro dollar. Brent $75 a barrel, down 0.2%. Gold currently flat at 2,749. Let's get back to the earnings story right now, because Volvo Cars is seeing full-year retail sales increasing between 7 to 8%. That is a downgrade to the previous forecast on sales when they had seen growth of between 12 to 15%. Very pleased to say I can be joined now by the CEO of Volvo Cars, Jim Rowan. Jim, good morning. Thanks for joining us. Why the downgrade to the outlook on sales? What is underscoring that?
Well, basically, we're seeing a softening in the market. So we're seeing lots of different factors. First of all, you see inflation, which is an obvious impact to car sales, to new car sales. But we're also seeing underlying changes in the EV sector as well. Partly that's infrastructure rollout has been slower than we would have expected or would have liked to see, especially fast charging infrastructure. And when you add all of these things together, you start to see a slowing in the market. The trade tariffs, I think, are another spectre on the horizon. And consumer sentiment is changing as we approach Christmas. And, of course, people look to where they're going to spend their money.
Yeah, so, Jim, you unpack there for us and outline a number of headwinds for this sector. Which, for you, is the most challenging of those headwinds in the here and now?
Well, I think it's the growth in the overall sector. So what we've found is in the first year, we've actually done extremely well, the first half of the year. So we've grown 10% year over year, 3% in the third quarter. But what we see in the fourth quarter is much more of a flat outlook. And that's why we've downgraded from 12 to 15% to 7 to 8% in terms of our growth outlook for the entire year. But it's really around three things. As I say, it's the high inflation rates. it's the uncertainty around trade tariffs, and of course, it's the change in consumer sentiment.
What's your level of confidence at this point, Jim, that 7 to 8% guideline holds?
Yeah, I'm pretty confident we'll hold that 7 to 8%. I mean, we're outgrowing the premium market. So if you look at the premium market growth, one thing that we are pretty pleased about is the fact that we've outgrown significantly the premium market from the start of the year. In fact, in the last 2 or 3 years, we've outgrown the premium market pretty significantly. That's helped, of course, by our new EX30, which is the third best-selling new EV in Europe. And of course, it's helped by our existing lineup of plug-in electric hybrids, which are extremely strong. So the XC60 remains the best-selling PHEV in Europe and has been for the last 10 months or so. So it's underpinned for us by a very strong mixed technology base. We have mild hybrids, we have plug-in electric hybrids, we have 5 new EVs in the market. So we're in a very strong position relative to the market, but nevertheless, the market is starting to weaken.
That broader market, Jim, as you project out into 2025, in terms of that softening demand for electric vehicles, when does that start to turn around, or is this a story and a theme that continues through next year?
Well, that's really the question at hand, isn't it? To say when does this market start to change? It's certain that it's a downturn at this particular point in time, but at some point in time the market will change, and the main thing for us is to keep investing in that relevant technology, while protecting the sales as much as possible as we go through the transition. Now, that transition to full EV obviously has taken a little bit longer than people would have expected or would have liked. And if you don't have the bridge technologies of mild hybrids and plug-in electric hybrids, it becomes much more difficult. So I'm confident for us as a premium player in the market, because of those different technologies that we have available, and because we've continued to invest in them, and because we have a nice wide customer and loyal customer base in 80 countries worldwide, coupled to the fact that we have cars in various segments and sizes. We have 30, 40, 60, 90, we have SUVs, sedans and wagons. So I think it's very difficult for those players that are only selling EV and they're only maybe in one segment. For us, we're much more widespread, and that's going to allow us to ride the storm.
Yeah. Jim, you're obviously, headquartered in Sweden, owned by Geely. You have manufacturing in the US, you have manufacturing in China, amongst other places. On the tariffs question, how much of an impact do you expect to see, and how are you specifically trying to mitigate that impact?
Yeah, as you say, we're very fortunate in so much as we've had a strategy for quite a few years now, which is to basically build where we sell and source where we build. And that's given us a footprint globally. We have manufacturing facilities in Asia and Europe and, of course, in North America. And that allows us to a great extent to circumnavigate some of those tariffs. We're affected by one car right now in Europe, the EX30, which is currently only built in China. And we started localization of manufacturing of that car in Europe back in the summer. So that car actually starts production in our Belgium facility in Ghent in the first quarter of next year. And so then that helps us navigate some of the tariffs that we'll see come in from the importation of cars from China into Europe. So it's a short-term problem for us, but it is a problem in the short term.
OK, a short-term problem. Talk to us about what's happening in terms of the partnership. You have a JV with Northvolt. Of course, it's the European attempt at building out electric vehicle batteries, facing some significant challenges, that business. When it comes to the JV with Northvolt, how viable is that business going forward, Jim? Is production still on track for 2026?
Well, right now we're still on in terms of the production plans. But one thing I should state, just to make clear, is that we are dual, in some cases triple sourced on our batteries, in many cases in fact triple sourced on our batteries, so we don't have any single point of fracture, and that's good. And again, it goes back to the strategy of making sure that we've got resilience in our supply chain. So for us, I mean, we're rooting for the Northvolt guys that they can get the funding that they required, but we're also at the same time we're pretty well mitigated by our supply strategies.
OK. It sounds like you're not overly confident in the fortunes of Northvolt. Jim, would you consider additional liquidity into that JV?
At this point, no. No. And it's not that I'm not confident of Northvolt. It's just that I think the strategy that you need to have these days, be that trade tariffs, be that making sure that you've got resilience in your supply chain by having more than one single supplier. So this is something not specific to Northvolt, but specific across general across our entire supply chain.
Okay, Volvo Cars CEO Jim Rowan, really appreciate your time this morning on the back of those earnings coming through from that automaker, of course. Jim, thank you very much. Let's get to the Asian markets right now. Check in with Avril Hong, who's standing by in Singapore for a check on those Asian markets. What's standing out to you so far in the session, Avril?
I think it's how subdued, lackluster we're seeing most of the stocks in the region. I mean, I'm just listening out to your conversation with the Volvo CEO. Trade tariffs are a concern not just for European businesses, but for Asian investors. 2 weeks out from the US election, you wrap in also concerns surrounding US fiscal spending, the Federal Reserve. Risk appetite looks pretty subdued. And other than Chinese stocks that are really charging ahead and how we're seeing the rest of the region, it's actually looking like it's struggling for direction. I did want to highlight what we're seeing in Japan because it's not just the US election we're keeping an eye on this weekend. Japan also has a general election, and polls show that the Prime Minister's ruling coalition could lose its majority. Is this a backdrop that the BOJ wants to hike rates in? We're seeing that weakness coming through on the Japanese currency, levels we haven't seen against the greenback in 3 months. Remember, that was before the August ructions. And if you take a look at this chart, it shows you how it's touched the 200-day moving average, which suggests we could climb further still on dollar yen. The yen, by the way, I think the worst performing G10 this month has lost about 6%. Now flip the board. As I spoke to you about just a short while ago, we are seeing that Chinese stock outperformance, and this chart, courtesy of our M-Life strategist Mark Cranfield, shows you how there's been a divergence between Chinese and India stocks. There's a reversal of the narrative we've been hearing for much of this year: long India, short China. And this speaks to, yes, the stimulus announcement of late September, but also how India stocks have been struggling against the backdrop of slowing growth and struggling earnings as well. Keep that in mind as we watch the moves out of Asia today. Tom.
Yeah, really fascinating change-up in terms of sentiment around Chinese stocks. Avril Hong, thank you very much indeed with the deep dive on the Asian markets, joining us out of Singapore. Here's what else to be thinking about today then. Of course, it is a big day in terms of the earnings story and sales, so keep an eye on some of the key companies reporting through the day. We'll be breaking those for you, of course, bringing you a number of interviews, including with Lloyds, Michelin and Kering, in terms of the earnings numbers coming through, of course, from those companies. Today, as well, we're going to get third quarter earnings out of the US. A number of companies in focus for us, including Tesla and Boeing. As you can see, Coca-Cola also reporting, as is IBM. And then on the macroeconomic front, we get the beige book from the Fed. That's at 7 p.m. UK time. So some more details in terms of building out the colour around an economy that remains relatively resilient. Coming up, talking of that, Bank of America CEO Brian Moynihan on why he thinks the Fed should not go too hard with rate cuts. That exclusive interview is coming up. And later, we're going to hear from the Deutsche Bank CFO on the lender's latest earnings. It was a beat for Deutsche Bank. We'll hear from the CFO. Stay with us. This is Bloomberg.
We not only have all the general economic work, we have the top research team in the business. They do a great job, Candace Browning-Platt leading them and all the colleagues around the world. But we also have 60 million American consumers. And so when you think about the U.S. economy, we have great insight into what's going on. If you look at that consumer spending this year, the month of October so far versus last year, or third quarter versus last year's third quarter, it's up in the 4 to 5% range, which is consistent with a low inflation, low growth economy. That's across about $1.25 trillion to $1.5 trillion spent in a quarter. So it's a big sample, and the people moving around, they spend it each quarter on all different things, but it's generally growing consistent where we were pre-pandemic when you had Fed funds rate at the 2% level, 2.5% level. You had inflation in control, and you had growth in the 2% level. So that gives us confidence that our experts that do all analysis are backed up by the data we see in our clients, and that's what we see.
For the consumer, is there a degree of bifurcation there demographically?
It's less about bifurcation, because I'd assume that there's sort of two. Look, inflation hits people in the lower income brackets more than it does others but the good news is gas prices have come down. Food prices have tipped over. Inflation's in control. It's down in the 3% range as opposed to it was running pretty hot. And so that helps. But if you have auto debt, that debt, and you want to get a new car, that debt is higher. If you have mortgage debt and you already had a mortgage loan, it's very low. And so it really depends on the consumer and really where they are. But the average American consumer has more money than they did before the pandemic, is in better credit quality before the pandemic, still has the money in accounts from some of this stimulus in the pandemic, and is spending money. And that's all good stuff for the U.S. economy because we're such a consumer. That's the unique thing about it. It's a consumer-driven economy. It's a consumer-led economy.
Are you thinking about making allocations or allowances for stress at this point?
We always do that. So every quarter we run stress tests, thousands of them. Every day we run them in the markets, business stuff. We always look at it. And so what's the case if it turns out the wrong way? So even how we set our reserves, we have a modeled series of cases we put in. So it's not all base case. Base case is about half, and the rest are stress cases, and you add them all together. We're actually set our reserves as if unemployment was going to be at 5% at the end of next year, not what the market predicts at 4.3. So there's a conservatism built in to that, and then we look beyond that.
There's also some potential complications for the Fed depending on what happens in just under 2 weeks' time, right? Does the fiscal scenario, particularly under another Trump administration, but also certainly there are risks when it comes to the Harris camp as well. Is that something that you're thinking about? So
I would separate a very near-term question of the Fed getting the trajectory. Our experts have them cutting again a couple more times this year, so 100 basis points this year and another 100 basis points more evenly spread each quarter next year, and gets to 3 to 3.25 as a terminal rate. And then inflation comes down to the 2.3% as we move into 25 and 26. And so that is a well-engineered Fed change. And so the danger is that data or they go too fast or too slow, and that risk is higher now than it was 6 months ago. And so as they move, everybody's going to watch them, and you see the sell-off in Treasuries one day, and you see the rally the other day. Everybody's going to watch all that.
OK, Bank of America CEO Brian Moynihan speaking to Bloomberg's Heidi Strauss-Watts in Sydney, talking about the Treasury market there on the end of that last question. And we look right now at the 10-year with yields up again around 3 basis points. Similar picture on the front end of the 2-year as well. At this point, let's bring in for a deeper dive on these markets Bloomberg's Valerie Teitel. Valerie, what is happening in these Treasury markets?
A lot of angst in the Treasury market, Tom. We just heard from the CEO, Brian Moynihan, there saying he's worried about the Fed cutting too much. The Treasury market is clearly worried about something. We've seen a spike in Treasury volatility. It's now trading at its highest it's ever been this year. In my next chart, though, it's going to show a little bit more about the direction that we're worried about the Treasury market moving. This is the put-call skew on the 10-year Treasury note. Now, note, we are seeing a very high cost now of hedging against higher yields. It's hit the highest this year, and it's actually the highest since September a year ago, and that's when Treasury yields hit 5%. So you can see this angst in the Treasury market. We're clearly trying to scramble for upside protection for those yields headed higher, potentially after this election.
Is the ECB's Christine Lagarde building out a divergent policy versus the Fed? What have we been hearing from her?
Look, we heard from Christine Lagarde yesterday on the sidelines of the IMF. She reiterated her worry over services inflation. We're seeing that we've had headline and core inflation dropping near the Fed's target. Services inflation, though, is at 3.9%. So that is on her mind, and she reiterated that to us yesterday. We also heard from quite dovish comments from ECB's Villeroy talking about the downside risk to inflation and growth. And, Tom, he called them significant. So we saw some weakening in the euro yesterday. It's actually at its lowest in 2 months. It crossed below the 108 handle yesterday briefly. We're a bit above that now, but it's been on a weakening trend. It's down 3% so far in the last month.
OK, Bloomberg's Valerie Teitel. Thank you very much indeed. Coming up, McDonald's is grappling with a severe E. coli outbreak in the US. It has killed one person and made dozens more sick. We'll bring you the latest on that story. This is Bloomberg.
There was a narrative that I think that was prevailing when this administration took office, that the United States was sort of on the verge of being surpassed by China as an economic power, that United States influence was waning in the world, that China's influence was on the rise. I think those predictions have very much been reversed over the course of the last few years, in large part because of the partnerships the United States has built with key allies and key partners.
US Deputy National Security Advisor John Finer speaking with Editor-in-Chief John Micklethwaite, of course, of Bloomberg in Sao Paulo at the Bloomberg New Economy Forum. Now, staying on the US and its attempts at building out a ceasefire, US Secretary of State Antony Blinken is in Israel making a last-ditch push for ceasefires in both Lebanon and Gaza before the presidential election. There seems to be agreement with Israel's Benjamin Netanyahu that the killing last week of the top Hamas leader opens new paths to ending the Gaza conflict. However, Netanyahu is vowing to continue fighting against Iran-backed Hamas and Hezbollah. UK Prime Minister Keir Starmer says Donald Trump's legal complaint against his Labour Party over election interference will not jeopardise their relationship if the former president wins next month. Trump has accused Labour of, quote, blatant foreign interference and illegal foreign campaign contributions to his opponent. The filing looks unlikely to gain traction as foreign nationals are permitted to volunteer for US political campaigns. And Donald Trump has promised tax breaks for car purchases, but only for vehicles made in the US. Trump did not specify whether the tax breaks will be available to many foreign-owned car makers who produce millions of vehicles in the US, including Volkswagen and Toyota. In addition to tax breaks for car buyers, Trump has pledged to impose steep tariffs on cars and other products made in Mexico, China, and other countries. Meanwhile, the New York Times is reporting that Jamie Dimon privately told associates he supports Kamala Harris and would consider a role in her administration, perhaps as Treasury Secretary. But the paper added that Dimon will not express his support in public over fears of blowback. Sources told the New York Times that Trump's election denialism remains close to a disqualifying factor. That the view, at least from Jamie Dimon, as reported by the New York Times. Just reflecting on the earnings coming through from Deutsche Bank, it's a beat in terms of the fixed income and currencies sales, and they now are weighing up a buyback on the back of a beat coming through in terms of the investment bank. So buyback approval has been sought from Deutsche Bank. We'll bring you an interview with the CFO of that German lender in the next few minutes. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London, and these are the stories that set your agenda this Wednesday. The global bond sell-off continues as investors bet on a slower pace of rate cuts from the Fed. The dollar gains against all G10 peers. It's a big day of earnings from some of Europe's largest companies, including Deutsche Bank, as the German lender reports better than expected fixed income sales and trading revenue. We will hear from the bank's CFO in just the next couple of minutes. A McDonald's share slide after its quarter pounders are linked to a severe E. coli outbreak in the US. At least one person has died, with nearly 50 falling ill. Let's just recap the Deutsche Bank numbers for you then. A big day again on the earnings front, and it's a beat in terms of fixed income currency sales. The trading business performing very well, an 11% increase in that unit for Deutsche Bank. The stock is already up more than 30% year to date, and as a result of the beat that's come through from the trading business, they have applied for a further buyback for that approval, and we'll wait to see if they get that. Again, in terms of the revenue from buying and selling fixed income and currencies, up 11%, outperforming JP Morgan, Goldman Sachs, Citigroup. Income from advising on deals and stock and bond sales also increasing 24%. So those two units performing very well and offsetting some softness when it comes to the corporate and private bank. You had softer, lower interest rates that weighed on income and some higher loan loss provisions as well. But that's offset again by the strength that's come through from the trading part of the business at Deutsche Bank. Let's bring you right now our interview and conversation with the CFO of Deutsche Bank, James von Moltke, who's been speaking to Bloomberg's Oliver Crowe.
We're off to a good start in the quarter, so that's encouraging. We think the conditions of the third quarter have carried through without the volatility, incidentally, that we saw in August. Usually, we see strength around a U.S. election, as investors and also corporates need to position and react to changes in the markets and expectations. And so that's what we'll expect to see really once we get past the milestone on November 5th.
Right, and also this year was marked by sort of a lot of provisioning for the post-bank situation that you're still dealing with. You're still awaiting a court ruling. We got some of that money back. Is it enough to justify a buyback this year? I know that you've asked for the authorization, or is it going to be more into next year? Can you give us clarity on that?
Yeah, so we have applied for authorization for a further buyback, which would be executed in 2025. Okay. The post-bank provision, we've seen a release this quarter, which is good on the basis of settlements that we were able to finalize. We have a court case today, actually this morning, so we're expecting more news on that. Hard to say what the direction is, but it's certainly been supportive. We think we've reacted well to the setback that was the court's sort of expression back in April. And it's gratifying to have gotten through that with strong capital and now with settlements behind us, a mitigation of the income statement impact.
And looking at that buyback into 2025, what sort of size are you aiming for?
Well, we won't speak directly to size, but we've laid out a sort of a capital plan, which is of increasing levels of return to our investors, representing a normalization, in some respects a catch-up, which we expect to achieve over the next couple of years relative to peers.
And also noticing that provisions were up, but interestingly down massively in commercial real estate. Can you talk us through that a little bit?
Well, yes. So provisions have been influenced this year by a few transitory effects, all of which we expect to either ameliorate or cease next year. One has been the impact of the post-bank integration. Second have been a couple of larger corporate defaults in Europe, which in our case were hedged. So the impact to shareholders, if you like, was moderate. But as you say, commercial real estate has been going through a cycle that we've been living with. We actually called relatively early for a stabilization in that credit environment. We've seen that continue in the third quarter, whether that's driven by interest rates, the economy, now interestingly lease activity, and of course the indices that you can see publicly. All of those things tell us there's a stabilization. For us, we were down by over 34% or so in provisions in commercial real estate, and actually that included a sort of an acceleration based on a sale that we're contemplating of some valuation adjustments. So we feel that trend is well established now.
And talking of sales, it's been a big quarter also for M&A within Germany. Your origination advisory business up 25%. You've been able to capitalize on that then?
We have. Sort of our market share this year, I mean, we're up significantly, over 50% this year on last year's revenues. With that, a market share gain to around 2.5%, 2.6% so far this year. That's encouraging. Mm-hmm. The wallet was a little bit softer in Q3, but we think that was sort of seasonal and temporary. The momentum is there, and we look forward with the investments that we've made in our origination advisory franchise to participating and further improving our market share.
And I wonder what it tells us more broadly about the German economy, because a lot of this M&A has been incoming to Germany and not sort of going out. Is there sort of a sense of Germany for sale a little bit, particularly with the weakness in the economy?
I don't see that at all. I think it's actually both ways, and whether it's M&A or just the foreign direct investment that's taking place, we see certainly two-way flows. I mean, Germany always has some sort of interesting features around sort of private middle market companies, sometimes selling strategically or to private equity, and then our large industrial companies making investments abroad. That has been the trend. I don't see that necessarily changing.
And then also on the question of M&A, obviously will not have escaped your attention what's been going on to Commerzbank down the street. And obviously there's been a lot of talk through the years about Deutsche Bank, Commerzbank potentially getting together. You obviously observed what's been going on. You considered getting involved, opted not to. I'd just like to get from you kind of the sort of process of what you observed and where you ended up into sort of the decisions you made.
Well, look, we're always looking at our option set, as any sort of well-managed company should. And domestic consolidation is clearly on the list of things that you would look at as you observe your option set. We've been, I think, pretty consistent in saying the industrial logic for bank mergers makes sense, but that we needed time to be fully ready, and that time hasn't come.
Okay, Deutsche Bank CFO James von Moltke speaking to Bloomberg's Oliver Crook, who joins us now for more details on this. So you sat down with the CFO, Ollie. They've beaten, of course, in terms of these results. What stood out to you in terms of the numbers? Because certainly the beat when it comes to the investment bank versus some of their US competitors was a standout for me. Does that power them ahead in the kind of quarters ahead, even as we get concerned about slowing interest rates and the impact there?
Yeah, absolutely, Tom. I mean, I think what's really interesting from these numbers and what we saw is, again, that FIC trading, which is really the thing that really investors focus most with at Deutsche Bank. And again, that was a growth of 11%. That is bigger than anybody on Wall Street. The sort of, I think the best that we had from Wall Street was Bank of America, up 8%. So it was really a decisive beat. It's a major business for them. That put their fixed income trading up 11%, their investment bank up 11%, but also some interesting things over in origination and advisory. You know, this is their sort of about sort of deals and kind of make an advising on that. That was up 24%. And again, the other key that investors will always be watching for is the buyback. Remember, Deutsche Bank put aside 1.3 billion euros in terms of provisions for some legal issues that they were dealing with to deal with this sort of this acquisition of Postbank that has been sort of in the years. It's been in the courts for ages. They got some of that money back, and what they have confirmed now is that there will be a buyback. It will be next year. They haven't given us the volume yet, but that is for this morning what really investors will be focusing on.
And Ollie, you asked him about this. The attempted takeover, of course, Commerzbank, at least building out that stake in UniCredit. What did he have to say about kind of consolidation in the banking space? How is that story impacting Deutsche Bank's broader strategy?
Yeah, so Tom, I think it's really interesting. Obviously, the Commerzbank situation has made huge headlines within Europe, within Germany, with the regulators and the government and, you know, kind of the banking space in general. But it's not the only sort of consolidation that we've had in Europe really very recently, right? There was obviously the sort of forced takeover of Credit Suisse by UBS. That makes an absolutely enormous bank over in Switzerland. There's now BBVA and Sabadell. This is a moment of European banking consolidation, a moment that we've been talking about for many, many years coming in the making. There is no banking union yet, but it seems a little bit like Andrea Orcel is trying to bring, you know, build it and they will come. Build the bank and the banking union will come. And for Deutsche Bank, really looking at this, they have to ask themselves what position they want to hold in a market that is a more consolidated market with bigger banks. Is there a risk of them falling behind? And I think that James von Moltke in that conversation really suggested that he is aware of that and that actually Deutsche Bank wants to play a very active role in consolidation in Europe in the times to come, but not just right now, right, Tom? He's saying that they're still sort of executing on their turnaround strategy. I tried to pin him down on when precisely they might get a more active, a more kinetic Deutsche Bank in terms of M&A activity. He said that possibly next year. So I think that is something that's going to be absolutely key, not just for Deutsche Bank, but for banking in Europe for the sort of months and years to come.
Okay, I like the framing of that. A more kinetic Deutsche Bank. So we'll see if we get a more kinetic Deutsche Bank.
And a more kinetic Germany.
In 2020, and a more kinetic Germany, in 2025. Okay, so that's the longer term story. In the near term, of course, we're going to be watching the stock and its expected move, of course, when that starts trading 8 a.m. UK time. Talking of which, let's get to the markets then. Maybe that is the catalyst for these otherwise pretty lackluster equity markets. Maybe it is the earnings story kicking into gear. Maybe you do get a little bit of optimism in the banking space in terms of the win that's come through from Deutsche Bank. So we'll see if that gives the DAX a lift at the open. Currently, European futures pointing up just 0.1%. The action has really been all in the bond markets, but again, it could change on the earnings story of today. The FTSE 100 futures currently flat as a pancake. S&P futures pointing a little lower by 0.1% after a pretty lackluster story yesterday across US stocks. Nasdaq futures currently off by 28 points. Let's flip the board and have a look at US Treasuries, because that's where the action really continues to be in terms of the sell-off in the bond market. Yields up, price down on expectations that the Fed will be more moderate in terms of its cuts going forward. There you go. Yields up 2 basis points at the front end on the 2-year at 4.05, and the 10-year is comfortably above 4.2. Euro dollar at 108. Brent trading close to $76 a barrel, just down 0.1% so far in the session. The inventory story and the build-up in inventories in the US adding a little bit of softness to oil in the session today, and gold still above those 2,700 levels, just up 0.1% so far in the session. To the chip space now. ARM is cancelling a license that allowed Qualcomm to use its IP to design chips, escalating a legal dispute that threatens to disrupt the smartphone and PC markets. The move ratchets up a legal fight that began when ARM sued Qualcomm for breach of contract and trademark infringement back in 2022. The cancellation notice gives Qualcomm an 8-week period to remedy the dispute. And John Jumper, Nobel laureate in chemistry and Google DeepMind scientist, says the first new drugs discovered with AlphaFold technology will be another 5 to 7 years away. AlphaFold is DeepMind's AI system that can predict protein shapes and help scientists, in their words, skip some of the steps of the process. It also predicts how molecules interact with DNA, for example. I caught up with Jumper at the Bloomberg Technology Summit here in London. Take a listen.
The resources within AI are growing so rapidly that if you look at the resources toward any particular area, it's just growing so quickly that we have more and more capability. And yes, a lot of it is going to go commercial and then hopefully be exploited to develop drugs that are actually available. And sustainably, I'm actually, in some ways, I think the commercialization is really good, that it's going to give us the prospect of sustainably funding this incredibly important technology. I think it is a challenge for academia, both the pace of change, the fact that this research, we benefited from working on this with a team of about 15. And a team of 15 is kind of hard to get cohesively together within academia. So I think, as well, the kind of costs of accelerators and others. So I think it's a challenge to keeping academia really, really relevant as AI grows. But overall, it's a very good thing. I think we're also going to see a maturation in terms of having good, sustainable businesses within it, as well as a healthy research environment. So I think I'm quite excited. And I think also within, Google DeepMind, we're still working on science. We're still trying to put really useful systems into the hands of scientists.
OK, John Jumper speaking there, recent winner of the Nobel Prize for Chemistry, and Google DeepMind director and scientist talking to me at the London Technology Summit hosted by Bloomberg yesterday. Now, some other stories making the news today. L'Oréal's American depository receipts fell by nearly 5% after the beauty giant posted disappointing sales last quarter. The firm blamed China's economic slowdown for sales dropping 6.5% in North Asia. The decline marks the fifth straight quarter of falling sales in the region. L'Oréal's CEO says he hopes China's government stimulus will help boost local demand. Starbucks shares fell in extended trading after the company pulled its guidance for 2025. The coffee chain reported its steepest quarterly sales drop in 4 years, with weakness especially evident in the US and China. Starbucks says withdrawing guidance for the current fiscal year will give new CEO Brian Niccol an opportunity to solidify a turnaround plan. And ECB President Christine Lagarde has challenged two of Donald Trump's key criticisms by defending monetary policymakers and the importance of global trade. Take a listen.
I think fair trade is a key boost for growth, for employment, for innovation, for productivity. And I would say that it's something that we should not throw away, because in any period of time where this country, the United States, has thrived, were periods of trade, not periods of I'm going to retire behind my boundaries and play at home. No.
I mean, there was a big UK media outlet that called the US economy the greatest economy on earth right now. I mean, would you agree with that? Where does it leave the rest of the world?
I think it depends where you are on the social ladder. I think you have to go further than look at the sort of aggregate numbers or the average numbers. It depends on where you are on that ladder. If you are at the bottom of the ladder, if you have small job, not much by way of income, I'm not sure that you think of, being in the first and best economy in the world. So everything needs to be considered. But it's a case that the US, for instance, has very high productivity, has a very vibrant tech sector, and has had it for a long time. So it has capitalized on it since the beginning of the 21st century. And that there is a lot of catch-up taking place at the moment. But I think you cannot look at that in isolation. You have to look also at the people. And I think if you look at the Gini coefficient, which is probably not the best way to measure inequality, the US is not doing so well from that perspective. So it's also a question of spreading and distribution so that all people can benefit. Sorry, I'm being political now. Forget it.
But do you worry about central banks being political or being dragged into the political sphere?
No, because I think there is a huge resistance to that in the decisions that we make, despite what is being suspected here or there in any place in the world. And I think for those central banks which have the privilege of independence, either by virtue of the treaties or the tradition, it's critically important to hang on to it and to defend it, because the credibility of an institution like a central bank really is a factor of how independent it is vis-a-vis the politics. And it's precious. It's very precious.
But do you think that you'll come under attack more? Not you personally, but just central banks. Donald Trump said, Jay Powell had the easiest job because it's a flip of a coin every month.
He should come and visit us. And I have thousands of hardworking people, economists, jurists, computer scientists, and I can assure you that they work super hard every day, not just once a month.
And that was ECB President Christine Lagarde speaking exclusively to Bloomberg's Francine Lacqua on the sidelines of the IMF annual meeting. Coming up, McDonald's is grappling with an E. coli outbreak in the US. It's killed one person and made dozens more sick. We have the latest. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, McDonald's shares fell in late trade after the US Centers for Disease Control and Prevention said a severe E. coli outbreak was tied to the fast food chain's quarter pounder burgers. At least one person was killed, dozens more fell sick, mainly in the US states of Colorado and Nebraska. McDonald's has identified onions as being the likely source of the outbreak and removed the quarter pounder from some restaurants.
The decision to do this is not one we take lightly, and it was made in close consultation with the CDC. It's important to note that the majority of states and the majority of menu items are not affected. Other beef products at McDonald's, including the cheeseburger, hamburger, Big Mac, McDouble, and the double cheeseburger, are not impacted.
Well, a risk-off mood in markets as traders weighing the prospect of less aggressive Fed cuts by the Fed. So we've transitioned from McDonald's to the broader markets. I'll just flag that for you because European futures are actually up just 0.1%, but there isn't a lot of action so far in these equity markets. Looking for the catalyst, will it be the earnings story? Meanwhile, when it comes to the risk-off sentiment, or at least some uncertainty around the geopolitics, gold has hit a record high on sustained haven demand, with investors monitoring the approaching US election, of course, and conflict in the Middle East. Let's break down some of these stories for you then and bring the analysis across these markets and bring in Aneeka Gupta, Macroeconomic Research Director at WisdomTree. Aneeka, I want to start, before we get to the gold story, and I know you've got some interesting views on that, I want to get your kind of take on what's happening in these bond markets. The sell-off continues today. I wonder if we're set for a repricing in the equity markets as well, on the back of the readjustment of views around the Fed.
Well, very good morning, Tom. We have had quite a few interest rate cuts being taken out from market pricing. And despite that, equity markets have digested it quite well. And that's largely been on the back of a much better growth backdrop. So I believe as long as we're seeing improving macroeconomic data, that continues to support equity markets a lot higher.
OK, and you have a view of 6,000 for the S&P by the end of the year, Aneeka. Look, we want to get your take on what gets you there and what assumptions you're making around that target for the S&P. Stay with us. We're going to go to a break and come back to you in a couple of minutes' time for further analysis on these markets. Aneeka Gupta, WisdomTree's Director of Macroeconomic Research, is staying with us. We'll have more from her in just the next couple of minutes. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak. You are watching, of course, Bloomberg TV, and we're going through the markets with Aneeka Gupta, Macroeconomic Research Director at WisdomTree. We left you with this. Aneeka is targeting 6,000 on the S&P by the end of the year. Aneeka, what assumptions are you making around that target?
Well, the primary driver is higher earnings estimates. We've maintained the 2024 earnings growth estimate of 8%, but we have lifted our earnings growth expectations for 2025 from 11 to 6%, and also introduced a 2026 earnings growth target of 7%. Now, this is primarily being driven by better margin expansion, and that's being supported by improving macro factors. And, if we look at it from a sector perspective, I think the biggest upgrades are really emanating from tech, where we've seen an 18% earnings growth, alongside communication technology, where we're seeing a 15% increase in earnings growth expectations.
Okay, that's interesting. You focus on communication technology and the broader tech sector, because my next question was about the impact and the challenge to that view from, for example, tariff risks, US political risks. Do you need to be focused on sectors that are more isolated from those risks?
Yes, absolutely. I mean, we've seen, the US elections does pose one of the biggest risks for equity markets, and investors are clearly being very careful on where they put their exposures in. But clearly, if we are, if we see an outcome where President Trump actually actually wins, that actually puts us in slightly less of regulation stringency impacting the tech sector. However, if it's the Democrats that come into power, that's likely to have a bigger impact from a regulatory standpoint on the tech sector. And the tech sector is the least regulated sector, when we look across the S&P 500. So that would have a big impact. Tariffs would clearly have a very important role to play alongside many of the other sectors, including manufacturing. So those two would be, primary risks that we would cite within the sector.
Okay, Aneeka, I want to zoom out for the earnings story to the macroeconomics and monetary policy with your view on the Bank of England. We've been hearing from the ECB's head in the last 24 hours or so, and it seems that they continue that path around rate cuts. What about the Bank of England? How much divergence do you see in terms of the BOE, the ECB on one side of the ledger, arguably, and the Fed on the other next year?
Well, the BOE clearly has been late, but we have seen a sharp shift in the narrative. Comments by Andrew Bailey are now hinting very much on the dovish stance. Clearly, we are expecting a 25 basis point rate cut for the November meeting. And subsequently, we do expect to see 25 basis points of rate cuts right up till the September meeting. That should take us to a final interest rate of 3%.
Around 3% for the BOE by next year. Aneeka Gupta, thank you very much indeed. WisdomTree's Director of Macroeconomic Research. Up next on the opening trade, we're going to speak to the CEO of Roche on the pharma giant's third quarter results. The opening trade is up next. This is Bloomberg.